Just to kind of give a context about what we are going to talk about, how important is tokenization today, I'll give you some big numbers. I'm sure many of you would know about it, though. We are talking about real-world asset tokenization in market, which is about $22 billion, has trebled in 1 year, just 1 year. And there are estimates that say that it can be between $11 trillion to $30 trillion in the next 5 to 8 years. So that kind of size is what we're talking about. And here are the key players who can maybe make it happen. So I'll start the session by asking some of the relevant questions. First, if I can start it with the case, what is the case for tokenization, and why do we really care? I mean, why are the traditional and the crypto players equally interested in this market? And if I can start with Christine, you.
Yeah,
what do you
sure.
think?
Thank you. Really a great honor to be here. So tokenization fundamentally modernizes how assets are created, distributed, and managed. The first thing is it makes assets programmable. We're actually converting financial services into microservices, and we're able to create assets and code them the way that we can program software. The second thing is we are building multi-asset interoperability. For those of you who are in TradFi or have had a TradFi background, you know that equities and dollars and credit and crypto all live in separate systems. But with tokenization, we're bringing them all together in the same operating system so they can operate seamlessly with each other through the software that we're developing. Additionally, we are able to experience accelerated product innovation. Now, think about how innovation typically happens in TradFi. You have one team of product specialists and engineers. They have maybe a couple ideas, and they kind of chart something out, and then they start building it waterfall. Then they have to test it, and then how long is that going to take to actually build something new? Now, in the world of crypto and DeFi, you have hundreds of teams working together on open source code, on token standards, all coming from different backgrounds, different experiences, and just accelerating the process of innovation. And then the last part is tokenization creates a killer cost base. Now, at a bank, and I know banks, at a bank, there are tens of thousands of people that are required to support the operations of financial services, doing reconciliation, doing paperwork. Now, with smart contracts, everything is automated. You don't need that operations cost base. So tokenization is actually the next evolution of capital markets. And I really mean it as an evolution because who's going to survive? You've got one side that has total unlock with programmability, multi-asset interaction, a killer cost basis, and essentially all of the attributes that I mentioned before. And then you have what we have today.
That's really a hell of an answer, and you really sound very excited about it.
I'm super excited about it. I've only spent like a decade working on it.
Yeah, if I can just ask Robbie about it, I mean, what do you think about Christine's views, and do you have anything more to add? I'm sure you have. So
Sure. Robbie Mitchnick, I'm the head of digital assets at BlackRock. And I think Christine gave a terrific encapsulation of the dynamic. So maybe I'll tackle it from a slightly different angle, which is to think about a very granular use case within a particular asset class for tokenization, because I think that's been the real rub in this space, is getting from this very enticing theoretical promise that Christine so articulately laid out to tangible on-the-ground impacts in a granular way. And the asset class that clearly I think has the most traction in the whole tokenization space today is these tokenized yield funds or tokenized money market funds. And the reason that tokenization is so significant in that context is that historically, investors of all types have always faced a trade-off between yield and liquidity. Either you could get full access to, as is generally the case, a U.S. Treasury full yield, or you could have full liquidity in the form of cash, right? But you couldn't have both. if you wanted even to hold a money market fund, traditional money market funds is either next day or end of day. Redemption typically limited to banking hours, doesn't work over weekends. And so this ability for the first time, because of tokenization, and as Christine describes, the way tokens can interoperate with each other, you have this exchangeability in a frictionless way between a tokenized yield product and a stablecoin, which can be moved anywhere in the world in near real time at near zero cost, much more efficiently than old world cash does. You put the two together and you have a fundamentally disrupting paradigm for the whole system that we use to handle savings and payments.
That's a very important point you mentioned about the real-time settlement also, that solves this issue of tokenization from the TradFi perspective. Getting to Tarun, you represent one of the core native crypto panelists over here. So what are your thoughts about, what does it help? What does it solve tokenization for the real world?
Yeah. I think the main thing, right, that we've seen with DeFi historically is composability allows you to basically make very complicated financial products out of very simple financial products, which means you can analyze the simple financial products, understand how they work, compose them with some rules and constraints via smart contracts, and get a more complicated product. One thing I think a lot of things in traditional finance don't have is that they tend to have a lot of peer-to-peer contracting, right? So if I'm creating a new fund, I have an LP agreement that is made for that fund that the LPs and the fund actually subscribe to. There's no reuse of any components. You're not reusing components in the LP agreement. Sure, lawyers will copy and paste things, but there's a sense in which everything is sort of bespoke every time you make a new fund. And I think the beauty of smart contracts is these modular components that you can put together like Legos allow you to have reuse of existing financial primitives, reuse of liquidity, which is one of the reasons you're able to kind of get yield and liquidity at the same time. And they also allow for public transparency of pricing and interest rates and things that are usually oftentimes much harder to understand the mechanisms for. So, I think if you've been in crypto for a while, you've of course heard about, Oracle problems or how people, get data on chain. But if you think about it, at some level, on-chain data is generally a lot easier to reason about than 90% of financial indices where I don't understand what happens at the opening auction. I have to think about the dynamics at the close. I have to think about the participants more directly. I have to think about, is this an MSCI? Wait, whatever. There's all sorts of custom stuff in traditional finance funds that makes it hard to reuse components. And I think this reusability of components is one of the most important things.
Very interesting. The logistics part is cut out. That's what you're trying to say. Yeah. Interesting. Reid, if I may come to you, you were literally joining the TradFi and the crypto world at Securitize. So when there are lots of on-chain assets, they claim that they are from the real world to the on-chain. Can you differentiate what is hype and what is real? I mean, there are like thousands of them, right? So can you help us understand what is real and what is hype?
Yeah, I mean, I think if you think about the idea of tokenization, everyone wants to tokenize something, right? And that's kind of a buzzword right now. And you have a huge kind of spectrum of different types of products that get tokenized. And I think you have to kind of ask yourself, like, why are you tokenizing something? Is it just because you can? And my view on that would be you probably shouldn't. Unless you're adding some level of utility or some enhancement in yield or kind of unlocking additional features or distribution, not everything needs to be tokenized. And so I think that's kind of, where everyone on this stage is providing some type of unique interoperability between the assets that those guys are issuing, these guys are doing things with, and then we're kind of sitting in between and helping enable.
Right. If I have to understand a little bit better about, in terms of, this was like a big picture, but when we have to zoom down between the DeFi and the TradFi world connecting with each other, and what exactly are we doing? What are the kind of compelling use cases that we are solving over here in this kind of a real world sense where we are marrying these two? So if I can maybe start with Christina on this, if you want to, or maybe Tarun will be better. What do you want to say?
Yeah, I mean, I think one important thing that you see in DeFi is these complicated structured products that generally need a lot of bespoke hand-holding from lawyers. need a lot of sort of maintenance from the thousands of people that Christine was talking about, can suddenly be 5 lines of code. And I think what that means is things that are, in TradFi, people would say will have a really high hurdle rate to be borrowed against. So like a certain type of position, it might be very expensive to actually syndicate a loan, figure out how to write the SPV, figure out how to find buyers. In DeFi, you can do that much more efficiently. And I think that's the core of all the lending markets. That's the core of also all the trading markets. And I think what you're seeing with RWAs is as they get more integrated via things like Securitize as tokens, you can start using them in DeFi as if they were normal tokens, and you can take leverage on them. That's sort of one of the things that we've been working on with both Securitize and others. And then once you can do that, then you've basically made something that would have had a much higher hurdle rate. Maybe you would have been paying hundreds of basis points, suddenly costs, a few basis points or even just a gas fee to do. And I think that reduction in cost basis for complex structuring is probably the number one feature and the number one reason I think you're seeing this increased usage of both real world assets being issued, but also real world assets being composed with it and other DeFi protocols.
That's a very important point for me. If you can come in over here, Reid, as well, and then I'll come to you, Christine, especially about the cost and how does it really help remuneratively also in terms of the returns. So could you add, anything specific to add on that?
Yeah, I think, when we talk about these two worlds, right, historically they've been separated probably because of technical reasons. You can't interop the same way. But also a big barrier has been regulation. And so something that Tarun was talking about in terms of how do these securities interact in the real world and kind of what happens with rates on chain versus what's happening kind of in the real world and other hurdle rates. And so one of the projects we've been working on collectively has been this S-token project, which is a technology that we've developed that provides an unlock for securities that are regulated and permissioned to interact with DeFi the way it operates today. So everything is not settled on the regulatory front, and I don't expect it will be for a while. But what happens is you have a bunch of capital on chain. People can iterate at much higher speeds. You don't need to have aggregated capital kind of sitting and go convince someone to underwrite a structure. You can just experiment. And so we've put together an exciting investment product which combines some of our forces. It leverages ACRED, which is Apollo's diversified credit fund, as a stable, sustainable yield that it has nothing to do with any supply-demand dynamics in kind of crypto, which is traditionally kind of the real source of leverage and interest rates on chain. Using our S tokens and risk management and capital through Gauntlet, we're offering a levered loop on this ACRED token. So that puts yield somewhere around 16%. It's permissionless lending from the DeFi world, and I think it's a really great example of how these two worlds don't need to stay apart, and they can learn and operate together better.
I mean, honestly, like this is the first convergence of TradFi and DeFi. And I've been waiting for this since I bridged my first assets on Polygon during DeFi Summer 2020. So, it's been a long time coming, but, we've always talked about mobilizing traditional assets. And by the way, we this is very exciting. For my part, we are focused on digital assets, tokenization, and DeFi because we're here to expand access to private markets. Apollo has more than 3 decades track record of generating alpha, basically creating what we call excess spread per unit of risk. We do this in a few different ways, like through our proprietary credit originations, through our value investor mindset, where purchase price matters in all scenarios, and specifically where we're aligned with our investors. If we're underwriting credit and that we're putting that in a fund that investors are investing in, we're also investing in it with our balance sheet. So we're totally aligned with our investors. Now, historically, private credit, private assets has only been the domain of the most significant institutions and sovereigns of the world. But what I'm really excited about is how I can provide access to all of that alpha to all of you. The next generation of crypto native investors that can benefit from our track record of alpha generation and with basically some of the really interesting features and functionality that this team has put together.
That's interesting. You democratizing private credit fund to the broader people, and that too at a high return.
Yeah.
Yeah. Okay, I have one question for Robbie, and then maybe I'll go to Reid on the same question. Basically, somebody like a TradFi investor who invests in U.S. Treasury kind of return, right? How do you convince that guy to switch to a money market, tokenized money market fund yielding a similar return? I mean, what are your arguments on that?
Yeah, well, we haven't yet. I think that's an important thing to understand is that when, at least not at scale, when we look at the tokenized asset category, and specifically tokenized yield funds, where the vast majority of the AUM is today, the predominant investor in that is already digital asset native. So they're on these rails and they recognize the enhanced value prop and utility of this technology over and above the traditional format. But what hasn't happened yet is a broad-based migration of those who've only to date been within the TradFi world actually moving over to be able to hold the same thing but in a tokenized format. And the way that we're going to do that is by expanding, continuing to deliver against real utility from tokenizing these things. And that comes in part by compounding the value prop, and Jeremy Allaire was just on stage before us thinking about stablecoins. If we get more of TradFi realizing the tremendous opportunity in stablecoins, then as a user of a stablecoin, holding your savings in a tokenized yield product becomes much more logical because you have that frictionless interoperability between them. We're not quite there yet, but I think the momentum is pretty significant.
You raise a very important point that stablecoins are a first step maybe for a broader, acceptance of the traditional world coming into the tokenized money market funds as well, which is important because that's the first step for a bigger play. If you have anything to add to that, Reid?
Yeah, I mean, I think it's a lot of the topics we've been discussing. I think, for a TradFi investor, there's kind of just the pure financial reason, right? Which is on-chain liquidity, instant issuance, and actually the daily compounding of your interest that you can use, right? Rather than waiting for your brokerage statement to come and need to interact with your custodian. But then there's also the world of composability and all of the other interops that are available to you once you hold the tokenized version of it. And I think you quickly will learn through everyone on this stage that all of these things are happening in real time really quickly. And I think once you start to understand what are the possibilities, it becomes a no-brainer.
If I can continue with both of you a little bit more. Firstly, I want to talk a little bit, to understand a little bit more about how the evolution between BlackRock and Securitize is going. What are the kind of products? I mean, how are you looking at going ahead about this? How is it going so far? And then I'll a little bit come about BUIDL to you, Robbie, about something on BUIDL, but first on how the growth has been so far.
Yeah, well, Securitize has been a great partner for us. They're our foundational partner in the tokenization space. That's been consistent with the strategy that we've undertaken in other key pillars of the digital assets universe. And so what has been enabled is tuning into the capabilities of the platform that they built, which has been the industry leader in many ways, and Christine and Apollo kind of reached the same conclusion, and that has been a pretty powerful combination in terms of bringing both TradFi and DeFi and digital asset capabilities together and jointly kind of building from the best of both, and then being able to go to market and to tell the story and connect with that wider audience that spans in many cases both TradFi and DeFi.
And how does it look ahead? How does it? What are the What is the strategy going ahead? How do you see
You
it
want the
going?
product roadmap. Can't do that.
Well, I'm a reporter. I have to come to a question that needs some news. Anything that you have in terms of what next for BlackRock?
Well, I think the most important thing to recognize is, as Reid just said, just because you can tokenize something doesn't mean you should, right? At least not yet. And so for us, it's a question of where can we find high conviction that tokenization is going to solve a real problem that our clients, whether TradFi native or digital asset native or both, have today, and deliver that unlock and see real commercial traction and product market fit. And so that's why you've seen us take a very discerning strategy to date, really one public blockchain product that we've been focused on and building around that. There will be other asset classes, there will be other opportunities, but we're not just going to scattershot, start tokenizing everything and see what happens.
Oh, makes sense, and that's pretty logical and reasonable. Reid, do you have anything to add to the partnership?
Yeah, I mean, I would think if you take a look at kind of the backgrounds, at least of the firms that are on the stage, Securitize has played a really important role in that. And part of our business is compliance and regulations and doing things the right way, which is the reason Apollo and BlackRock work with us. But on the same side, with S tokens and some of the other projects that we're working on, we're able to actually connect these assets that are permissioned and security in the right way with platforms like Gauntlet, Morpho, Elixir, names in the DeFi world that you guys will recognize. And so I think what's most exciting for me that's coming down the pike is not necessarily some new asset that's coming. We've got two fantastic assets right now that are playing today live in DeFi. And I think the expansion of that interop between the permission TradFi world on-chain and platforms doing really exciting and interesting stuff, that's what I think this is all about. Let's bring the base assets on-chain and then let's crypto kind of build on top of them. And again, it's this symbiosis that I think historically has unnecessarily been separated.
That's nice. I wanted to understand, Robbie, also a little bit about, I'm sorry I'm hogging I just wanted to kind of come to you before I go into the next part of the question, but about BUIDL and the interconnectedness with, for example, the Ethena stablecoin. And I want to understand how how much is BUIDL exposed to the demand side shocks or impact from this kind of interplay.
Well, I think in general, when you look at the tokenized yield fund category, it's basically solving 3 use cases today, which maps to 3 client segments, and there'll be more over time. But today, it's a combination of tokenized yield strategies, leveraging underlying tokenized yield fund building blocks. So that's kind of category 1. Category 2 is stablecoins and variations of stablecoins that are using tokenized yield funds rather than having to use a TradFi money market fund or SMA type arrangement, being able to actually have the underlying reserves in an on-chain format that's attractive to them. So, Ethena is one example, as you note, and there are others. And that's been certainly a segment that this category is growing. And then the third is sort of DeFi use cases, a lot of which today is collateral. And I think the collateral segment is small today, but growing pretty rapidly. And we've seen a lot of interest from exchanges and other DeFi protocols of how do you wrap a tokenized yield instrument, or how do you deploy a tokenized yield instrument on a platform and be potentially a very compelling collateral instrument for users.
But how does it impact in terms of the demand pressure on BUIDL? Does it make it a little more susceptible to risks, to kind of demand side pressures?
No, if you think of BlackRock's global cash business, we manage about $900 billion. And so the liquidity of the underlying pool of assets, which is really U.S. Treasuries and repo, is orders of magnitude larger in scale than what we're doing today in a tokenized yield fund context.
Got it.
That was such a flex. That was such a flex. I love it.
Yeah, he gave a very big picture view from BlackRock. That's actually realistic. Coming to the interplay between, crypto adoption, especially by institutions, was in 2024 saw a big jump, especially by all of you guys over here. How does it look like the adoption by institutions for tokenization, and how does it play between crypto and tokenization when it comes to institutions going ahead? I can start with maybe Tarun first, and then I'll come to Christine and Robbie maybe.
Yeah, I mean, I think the main thing we've seen is in general, if I take a sort of like historical lens of crypto cycles, you have a sort of ebullient sort of bubble slash high growth cycle, followed by sort of generally the sort of bear cycle where people are generally trying to preserve assets rather than kind of invest in new assets. And what you have at each cycle is sort of this kind of money multiplier kind of effect where like you start at 10, imagine you started before one cycle, there's $10 of new capital. At the peak of the bubble, there's maybe sort of $1,000 of levered capital that's in the system. At the end, in the bear cycle, there's maybe around $100. So sort of the crypto general stable capital has grown over time. And if you look at each cycle, what has caused the kind of net retention of capital at each cycle? It's usually some technological innovation. So after the ICO boom, you saw a huge growth in stablecoins, especially in USDT and USDC. And then after DeFi summer, you saw a huge growth in money markets and people actually leaving things in on-chain yield. And I think effectively what we're seeing now is the RWAs are providing a reason for you to not leave the chain. You maybe went on chain, made some money, maybe you traded meme coins, but then now in past cycles, you might have said, okay, I'm going to take my money off and go back to US equities. But now you actually don't have to leave. And I think this notion of this retention effect being much more enabled by each new wave of assets is really important. And to have that keep growing, you need to have composability and you need to have a way of being able to offer yield even through the down cycles. And RWAs act as a sort of counter-cyclic instrument that provides that yield during those times.
That's an important point. Stickiness and scalability, I think, go hand in hand. That's nice. Can you help me understand a little bit more about the interplay?
Yeah, sure. I mean, like I said, I've been working at this for about more than 10 years now. So, I spend a lot of time thinking about why am I doing this? And it hasn't been easy this whole time, right? Now,
was the answer easy? Sorry for borrowing.
No, I mean, the answer is that I'm looking to build 10x better experiences for all of us with financial services, okay? So let me just give you a very simple example that maybe you can relate to. Today, when I get paid my salary from Apollo into my bank account, I just get paid. It's a direct deposit and nothing happens. I don't do anything with it, mostly because I'm a hot mess and I'm busy working. I maybe look at it and say oh, I have this much, I have to pay my credit card bill and I have this much cash left. I should do something with that. Most often than not, I'm not doing anything with it. But if I was doing something, maybe at best, I would deploy that extra balance of cash into treasuries, get a little bit of yield. And, that's 5 button clicks later, got to call someone to confirm something. Maybe if I was especially ambitious, I would invest in Apollo funds. But again, takes a lot of effort. And then, today or in the future, when we have our crypto wallets, and what I meant to say is that the crypto technology exists today, in the future, I can get paid direct deposit into my crypto wallet where I actually have the perfect portfolio designed for me, designed for how much money I need to spend, what my risk profile is, how much I'm saving for retirement. I know y'all aren't thinking about retirement yet, YOLO, but basically designed just for me, customized to my risk profile. And it would look something like, I need 10% stables, I need 20% treasuries, preferably BlackRock, I need 25% levered yielding private credit, and 25% crypto in my portfolio. And what should happen and what can happen with the crypto technology that exists today is that I should get paid. It deploys into like stable coins and then automatically swaps into that customized pie chart of investments just for me without me having to do anything. And the net effect of that is that every penny of my earnings is fully invested and yielding without me actually having to do anything. And then, you know, when I go out and I take the crew out here for sushi, and I'm at the restaurant, and I'm like, okay, like I'm gonna pay Nobu. I mean, it's not gonna actually be the crew; it'll be much more expensive. Like I want to pay $100 to Nobu. Then that's an automatic swap. This is where DeFi comes in, right? An automatic swap out of my BlackRock treasuries into stables, off ramp to pay the restaurant. So I'm earning and yielding until like the very last second that every penny is leaving my account, right? Like that is absolutely a 10x experience for not just people, but also like, first of all, first world people, but then also people that are underbanked or unbanked, right? Like, and the interesting thing about this technology is that you can scale up and down. It doesn't matter if your account has $100 or $1 million, the technology still works the same at a killer cost basis. And it's also relevant for treasuries, regardless of if you're a small business where you might not have the capacity to manage your finances because you're so busy on making your business, or if you're a large cap with many millions of dollars in your treasury, could also benefit from active management of your treasury. So this is the reason why I build on blockchain. This is the reason why I tokenize. So, you know, it's baby steps. And like I said, it's taken a little while, but we're moving, like accelerating towards this vision so that we can all have better financial experiences.
Thank you. I think I just give the last one to Robbie because we're out of time. In 30 seconds, sum up what's the big deal about Interplay.
Yep, I'll do the very quick version. So, initial hypothesis that a lot of people held was that tokenization would unlock participation eventually in crypto by institutions. I think the revised hypothesis that most people are now seeing is that crypto adoption by institutions, allocating some small portion of portfolios to this new asset class, is actually more likely to go the other direction and be a catalyst ultimately to adoption of tokenization by institutions.
On that optimistic note, that was a great evening. Thank you so much for the chat and wish you all a great evening. Thank you.